Joining us now is SEI Chief Investment Officer Jim Smigiel and Baird Investment Strategy Analyst Ross Mayfield. Good afternoon to you both. Jim, I'll start with you. Yes, stocks closed higher today, but we also had the yield on the 10-year at a fresh high going back to 2007. Can these two things coexist?
Thanks for having me, Morgan. And I think you're right to focus on that. That relationship is usually a lot more stress than we've seen thus far. It's really been the year-to-date story, quite frankly, as the markets have been absolutely resilient, even in the face of higher yields and a more hawkish Fed than the market has perceived early on. We think eventually this breaks a little bit. We are very, very cautious on equities as it stands today. We definitely prefer a broader, kind of more diversified exposure in large cap and a bit of an underweight to those magnificent seven names and really those kind of top tier growth names that tend to have higher interest rate sensitivity. So you're certainly right to point out this has been an unusual year from that perspective. We think eventually this all gets caught up and we see the interest rates eventually weighing on these top names into year-end 2023.
So seasonality, we've been talking about it, that, September, historically the weakest month of the year. But then you have these decidedly, I should say, unseasonal factors that could make Q4 extra messy. Impact of higher interest rates, student loan repayments, higher energy prices. You got the UAW strike and, perhaps this government shutdown. Ross, want to get your thoughts on what it is to climb this wall of worry right now and how investors need to parse what could be a pattern versus what might be uncharted territory.
Yeah, absolutely. Well, first and foremost, I do think that having a wall of worry as an equity investor is a good thing. If sentiment is unequivocally bullish, you might want to look the other way. There obviously are some big headwinds. Government shutdown isn't something that has historically been a big weight. The student loan repayments is uncharted territory. We'll see how much of a headwind that is to the consumer. We can see consumer discretionary stocks taking it on the chin lately. Part of that is higher rates, but I think part of that is the market sniffing out that the consumer might finally be close to tapping out after carrying the economy for the better part of 18 months. I do think, though, that the markets are set up to have a strong Q4 if we can get an assist from rates and or energy prices. If both of those continue higher, through October into November and December, it's really going to be hard for equity prices to get that rally in. Those higher rates are a huge headwind, and obviously those energy prices weigh on consumer sentiment and consumer spending via gas prices. So if one of those can crack, I think we're set up well.
Okay, so how would you be advising investors to set up right now then, Ross? What are you betting on?
Well, look, we're not scared of equities right now. I think, there could be some volatility in the near term, but there's a pretty strong setup longer term that we still like. At the same time, most of our clients are wealth management clients. They've been investing and saving for long periods of time and haven't had an opportunity to get yield from fixed income for the better part of 15 years. I think we're probably at or near peak rates. Obviously, saying that over the last few months has led to some pain because rates have marched higher. But at some point, the Federal Reserve will reverse. We think grabbing some high quality fixed income treasuries, maybe adding some duration to capitalize on both real yields being at, 10, 15-year highs, but also getting that pop in prices when the Fed eventually reverses and yields come down, whether that's a soft landing or a more typical recession progression. So I would be, talking to folks who are in the right, demographic and risk profile about adding to fixed income here and high quality fixed income, to be sure.
Yeah, Jim, I'll ask you the same question, especially since we get that final GDP reading later this week. And there's this sense that perhaps we are seeing signs that economic growth is going to continue to soften here with rates higher for longer. At some point, there's an expectation that yields are going to have to move lower because it becomes a safety trade again. So how would you advise investors to position? Is it stocks? Is it bonds? Is it something else?
It's going to be both for sure. We're definitely closer to the end of the rate hiking cycle than we are at the beginning. We think there's still one more hike kind of in the tank between now and the end of the year. So again, we are kind of shying a little bit away from the very concentrated parts of the equity market. We like things like value. We like sectors like materials. We like sectors like industrials, those that have slightly less interest rate sensitivity. Diversified is always the way to go. That's always what we're going to be preaching to our clients. And that's the right position between now and the end of the year. We do have GDP, but we also have the PCE, and that's really kind of the key issue. That's the Friday number. Is that going to be coming in at 3.9%, which seems like expectations? These are still very, very high numbers. These are still well above the Fed's target. Chairman Powell went out of his way to say that they're not going to be adjusting their 2% target for inflation, and that's going to keep them higher for longer.